All right, good evening, ladies and gentlemen, fellow traders. Welcome to this session today. It's me here, Matthew, with my colleague Robert. Robert, you want to say hi?
Yes. Good evening, good morning, good afternoon from wherever it is that you're watching this presentation from. Welcome, traders. Let's have a chat. Let's see how we can manage our risks, which is the only holy grail in trading. Okay, let's see how it pans out.
Let's see how it goes. Yeah, today we want to look at risk management. Just give you a little bit, few tips. Okay, we don't have much to speak today. Just want to highlight key things that you should be looking at in trading, right? And take us to the next level, Robert. I mean, we're looking into consistency, right?
Yes.
Yeah, consistency in trading.
Challenge. It's a huge challenge.
It's a huge challenge, yeah.
It's a huge challenge because, as traders, at some point in time, you realize that you may be good in skills, but then again, it's not about the technical skills, the fundamental skills, whatever it is that you're looking at, even if it's your strategy, then you must remember there's something more that
Okay,
the underlying the belly, what it is that you're looking at, how do you risk your trades?
I
That's a
get you.
process. Yeah.
I get you. And then it's as traders are looking forward to get the consistency, there's this misconception that easily comes up about making money. People are expecting to make money quite easy. Do you think it's the case? Is it quick money?
This
in
is
your
not
case, Robert?
I think everyone who begins in this business starts off with a get rich quick mentality. Until, I always say, probably in our sessions here in Thika, I always say that the worst thing as a trader you can do is start off on a winning streak, right? The beginner's luck, right? So anytime you have that, then you expose yourself. You realize, oh, I'm making this amount of money, and yet at that point in time, you don't even have the knowledge. You don't even know why you're doing it. You've just seen a red candle going short, and you said, you know what, this is dropping. Let's drop. You don't know you don't know nothing. So I think as traders, this is where most guys who are coming in, the new guys, and are coming in with that mentality of, I'm making money because I saw my friend making money. But, later they realize, you know what, that's not the case.
I mean, everyone needs consistency. Even for the experienced traders, you want consistency, and maybe you want to give meaning to the word consistency. What does consistency mean? It's where, in my opinion, it's where you're able to keep doing what you were doing over and over without having to stop at some level because of in the event of trading, because I've been making so big losses. So you want to be trading, you want to balance the losses and profits in such a way that you're in the markets, you're making money, you're making losses, but you keep on going because, of course, you're able to balance and make more profits than the losses that you're making. That's my idea. What about you, Robert? What's your thought about consistency?
I couldn't agree more on that. At times in this trading business, in all honesty, there are times you'll have a losing streak, right? There are times when you'll have, let's say, 5 trades losing streak. And at that point in time, the mind kind of switches off and kind of blocks you. It's pain. The brain is kind of experiencing some kind of pain. So this is where you have that whole blockage where people are unable to, they have the best analysis. That analysis as the projection has been okay. That trade setup is probably your best high probability trade, but then you freeze when it comes to clicking that buy button. So I think this is where we should always remember that this is a business where we need to treat it as such, knowing that you should look for more wins than losses, right? Make sure that, and this comes with your risk to reward, right? So if you have a risk to reward of 1:2 and above, then that means, let's say if you have a risk to reward of 1:5, that means you'll need 5 losing streaks to break even, right? So to go back to where you are. So this is something that, of course, in our training centers, Kitengela, Nakuru, here in Thika, Eldoret, and even Nairobi, you get to learn more about these strategies and make them part of your trade management tools.
Right on point, Robert. So we're trying to put this together by guiding traders to learn how to have the ideal process and practice your process up until you're able to get the consistency that you need in the market. So it's important to look for profits. It's important to look up to that money, because sometimes it doesn't make sense when you tell people that don't focus on the money, focus on protecting it, yet you're trading so that you get money. So the thing is, yes, you get that money, but you need to develop a process, have a process that you're going to follow up in the market, practice your process up until it sticks into your way of trading. And then with that, you're going to get significant profits over and over, and it's going to be very important. Good that you've taken us to this quote here. Yes. By Paul Tudor Jones.
I love this guy. He's the hedge fund guy who made me at some point in time realize that you can crash, but if you still have the will, if you have the persistence, in this business, he had an interview with Goldman Sachs, and we were saying like his father at one point in time told him he needs to drop this thing and look at some stable job, like construction or real estate. But he told his father, no, I'm good. At that point in time, he had taken an account from, I think, was it $10,000 to, I think, $20,000.
Just around there, yeah.
Yeah, lost the money, then again came back. But you see, most of these guys will tell you that at some point in time, and I love more Ray Dalio, Bridgewater's, because he says pain plus reflection is equals to progress. So at one point in time, you'll have to realize, are these losses because of my indiscipline, when it comes to risk management, where like you're supposed to have a consistent lot size you're using. Probably you're supposed to use a mini, but when you're in a winning streak, then you start choosing a standard. So these are some of the things that probably we should look at these and correct that as traders when you're developing your strategies. So which goes back to that point, like there's always that temptation to increase the lot size of the trades, more so when one is having a streak of profitable trades. What do you say about this, Matthew?
I mean, you see, if I would want to know one trader that has never gotten these temptations. You see, there's that point where you have a trade in play and just about to have the stop loss to be hit, and then you feel like, well, I have an idea or some level of confidence that this might be a little pullback before you have a continuation, and there's that temptation to just pull the stop loss a little bit away.
Yeah, or remove it totally.
Because you're expecting the price will just reverse anyway.
It will reverse.
I mean, that's where that's a little bit of an emotion which sets in.
Yeah.
And that's where the difference comes in between a human being trading and a robot trading or an expert advisor trading. Those are the kind of things that's why the robots perform better than human beings. So how then should we weather this one out? It's just, if you've placed your stop loss, just leave it there. Respect it. Let it do its work. Yeah.
Exactly. So
just a consistent risk here.
I couldn't agree more. If you look at even web trader, FX web trader, you can see like you have clearly defined ways of how to mitigate your losses. So when you input in your stop loss, it clearly shows you that if it's 20 pips, you'll be losing, let's say, $20. So if it's for the profits, then take profit, you're, let's say, targeting 60 pips. You can see, like, for example, if it's Euro USD, the pip value being $1, let's say, on a mini. So that tells you that you're planning out something, but indeed it's set out. So you already have defined your losses. So just set out your risk, just go, walk away. Let the trade play out, because you'd already defined that I'm ready and willing to lose this amount of money. So, and I think that's one of the ways that helps in, the whole emotional roller coaster that comes in when you're trading.
Okay, so just adding again to the aspect of leaving out your levels, set out levels, whether it's stop loss and take profit to be hit. You see, you're only able to learn from a trade which you leave to independently run and then see, am I putting the stop losses at the right levels, right? If I'm looking up for double reward, or maybe 2-to-1 risk reward or 3-to-1 risk reward ratio with my strategy, so is it able to be achieved, right? How many times am I having the stop loss being hit? Because now you realize if you interfere with the stop loss, then you can't understand or know the win rate of your strategy. Maybe if you had left at that point where you had your stop loss, maybe exactly at the swing highs or swing lows, probably you might find that at the time when you interfered with the stop loss or take profit, it wasn't taken, right?
Yeah.
And then you have a false idea about the trading strategy. So if you want to have understand the trading strategy properly, make sure at least you leave those setups to run by themselves. Another way I would want to look at consistency is, and this is for experienced traders. You've been growing in your account. You've been disciplined for quite some time, using maybe a specific lot size. Maybe it's a micro lot, or maybe 2 micro lots, or a mini lot. And then after some time, after you've grown your account, now you decide, well, let me raise the lot size.
Yeah.
Right. So you jump from a very low lot size to a very high lot size, and then it erodes your profits within a very short time.
Yeah. Okay. So yeah, I think this is a temptation that every trader has gone through, or is going through at this moment in time. And I believe one of the ways is to make sure that especially during a winning streak, remember, there's a Swahili saying that says mpandangazi ushuka. When you're at the peak, remember, you have so much to lose now. So increasing a lot size then exposes your risk. And I think this is a mistake that most people make, especially when you're overconfident and you believe your setups have been playing out. Probably you've been having a winning streak of like 10 trades.
Okay, so the argument here is that you can change your risk management, right? You can increase the lot size, because of course you want to keep on having different targets for different account sizes, but then it has to be based on valid reasons. If you check out on our previous session that we did, we're talking about how to estimate the lot size which you are using, just considering out the stop loss pips that you are looking to set, and then what risk amount that you are setting up for that specific trade, and then you can estimate the lot size. So one way of managing that one is having or making sure that the lot size that you're using is in line with a formula that you're using for the account size that you have, right?
Couldn't agree more. So as traders, of course, now when it comes to definitely taking those trades, you must make sure that what is the long-term trend, and this is like you must make sure that your analysis probably is best done on higher time frames, so that this gives you an edge in the market. So, and of course, once you realize what the long-term trend, then you're not fighting what the market is doing. You're probably looking for opportunities to buy the asset at a discounted price. What do you have to say about that, Matthew?
I mean, a trend is your friend until it ends. Awesome. A trend is your friend until it ends. So it's just like the flow of a river. Like, for instance, if you're swimming against a river, you're more likely to exhaust yourself. Once you get exhausted, then it sweeps you away along its course. So the same case with the markets. I mean, we have strategies that don't really care about the flow of the market or the trend, but for someone who is starting up, and even for the experienced traders, I mean, the flow of the market is very important. So the advice is just find out the trend. Is it a downtrend? Is it an uptrend? Is it a ranging market? And have your trading strategy align with the flow of the market, because that's where the strength of the movement is most likely to be.
Couldn't agree more. One other way of maybe having a look at your risk management is the whole exposure part. Most of us know position sizing as an exposure, but we can also be looking at the trades you're taking. How correlated are they? So this one is one of the ways that you'll find, let's say you're taking a pair like, let's say Euro USD, you're looking at GBP USD. Let's say you're taking the majors with a base currency, let's say Euro USD, and we have the quote as the same, the USD. So that means that if USD increases, then all of a sudden, if you are bullish, then that means all your trades go into negative. So these are things that we as traders need to consider when we are taking our trades, so that we are not exposing ourselves to just one set of assets that are moving in a certain way.
That's for sure. That's for sure. Like for the past couple of weeks, and even right now, we having events coming up that are driving the currencies, driving economies, shaping sentiments. Like, for example, when we had rising rates and they're making a USD very strong. So what happens if you've been trading on currencies where there are currency on pairs where USD is part of it? So it means the strength of the USD has to be taken into consideration. Like if you got pound USD, like you said, Euro USD, USD yen, you see, in that case, if the USD strengthens or weakens, then it's going to have an impact on the movement of that pair. So when talking about overall exposure, there are cases where if you're long or you're buying USD and you don't realize that you are in trades, you have several trades holding them, and there's USD in that pair, you're either going to be exposed such that all your trades will be losing, right? Or it happens another way, that you are holding opposite trades. Yeah, when one is getting in the profit side, the other one is getting on negative side. So you actually not you net zero, like you're not getting any profit, right? So the advice here is always good to look at the currencies you're trading. Look at the correlation. Are they positively correlated or are they negatively correlated? Yeah. Yeah, because the way you're trading them, you might be looking into diversification, thinking that you're diversifying in the positions you're holding, but then you realize that it's like having the same trade. Yeah. Like you're showing us euro dollar and USD Swiss.
The negative correlation between these two pairs. And so of course, we are looking at the USD. If the USD is strong on the euro, then that means the euro will go down. But if it's strong on the franc, then of course USD, the asset will be on an upward move. So these are areas that you really need to look at, and vice versa is true. So you really need to look at it from this angle as a trader, so that you're not exposing yourself to asset classes that that are moving in one direction, so that you have some way of mitigating your losses when, because we will not say if, because the market is just a matter of time when you have the irrationality of the market.
Sure. So when you look at these two currencies here, you realize when euro is rising, when euro USD is rising, the USD Swiss is falling. So in this case, if someone was long on euro USD and you are short on USD Swiss franc based on that trend, then you're like having two similar trades, right?
Yeah. You have two similar trades.
Yeah, and if it happens that you are long on both trades, now you'll be having two trades which are going opposite to each other. When you're making profits on euro, you're making losses on USD Swiss, and you start wondering what's happening.
Yeah, so I think these are some of the things that we really need to consider when we're looking at also the aspect of risk management. And also when you're managing your trades, you make sure that you're opening trades, especially when you're having those winning streaks. You go to your market watch list and you realize, oh, I can take on this pair. Before you take on that pair, ask yourself, how correlated is it to the pairs that you already have? Otherwise, you could be doing a zero-sum job where like you are in profit and you're in losses, but when you close the trades, you're negative or even zero. So you need to be sure as to how you play out your trades.
All right. So he's showing us other currencies with like positive correlation, right?
Yes, Euro USD and GBP USD.
Okay, so one thing to consider if you want to understand the likely correlation in assets, look at Are the currencies that resemble, is it the quote? Is it the base? Like in this case, you have the USD as the quote or the counter currency, yeah? Or the second currency in the pair.
Yeah.
So whenever you find something like that, there's more likelihood of a positive correlation, but then it is offset by the base currency because you never know the characteristics, right?
Yeah, exactly. Some fundamentals could come in and all of a sudden, something in the euro could change everything. So these are areas that, this is a business where like you have to be up to date. You must make sure that also combining your fundamental analysis, making sure that you know what is happening in the calendar so that you're not caught flat out.
Sure.
Yeah.
All right. So we have here Aussie dollar, Kiwi dollar, right?
Yeah, and the Kiwi. So these pairs, especially, during Asian session, they really go a long way. So, and I think as traders, you need to consider also the Audi USD. And in most cases, Audi is the one which drives the Kiwi actually. If you look at your charts, Audi is more, in rare circumstances, have I seen the Kiwi driving the Audi. I think it's all about the economics aspect. Of course, Australia is bigger than New Zealand.
Right. But I see we have Dennis here. Hey, Dennis, we're speaking about the correlation of assets. We have these two currency pairs with positive correlation. Dennis, if you can hear us, what do you think? What do you think about the correlation of assets? How do you handle them when you're trading two pairs and they like almost the same? Oh, Dennis, we've lost him again, huh?
Yeah, probably.
Okay, now let's go to the next one, the other currency, which is correlated.
Yeah.
All right.
So here we're looking at commodity currencies. Basically, if you look at the Canadian dollar, that is mostly moved by oil, right? Because Canada is it's a oil producing country. So you should understand that anytime there's anything, let's say, for example, if you're looking at the OPEC meetings, you must remember, you must take into account that if you're in a position on any card pair, such a meeting could, prove will bring in something, will be detrimental or even good for your account if you're on the right trend. So these are some of the things that you really need to look out. If it's Australia, of course, the whole gold and iron. Australia is a gold producer, so you need to be sure when the markets, for example, we know gold is a safe haven pair. So when, for example, there's some turmoil in the world, we know gold XAU USD will be on a rise, and that means, that will mean the gold that is mined in Australia will also be on an increase. There'll be a demand for it. So that means that the Aussie will definitely be in high demand, which could mean it rising. Yeah.
That's a great one. I mean, correlation of assets is very important. Apart from risk management, okay, it's also part of risk management is where you introduce hedging. Okay, so if you ever thought of hedging as part of your trading strategy, because hedging is where you've been getting, you've placed a trade, and of course, there's no one who is like 100% sure of the movement that a price can take or a financial instrument can take. You're never 100% sure. We just have a level of confidence. So sometimes you have the price going, especially for the guys who are swing traders and the ones who hold positions for long. You might be net long, but then you realize that it's taking a correction to the downside. So how can you protect yourself from the short-term losses? That's where you need to know the currencies or the assets which have got a positive or negative correlation. So you take a position in another asset so that when you're getting losses in the position which you're holding for long, you can at least weather out the loss by taking another position, right?
Cool.
So So for the people who've been, I get a lot of questions about hedging in the market. So if you've ever thought of hedging in the markets, then it's important you understand the correlation of assets so that you know which other asset can I enter a trade in, so that I protect myself, or I protect my positions from the current maybe losses, which are likely in the short term before the key trend resumes again.
Yeah. Market correction is something that we really need to be we need. There will always be retracement. There's no market that will always be on an upward trend or a downward trend. So
sure,
you should be able to know that when let's say, and especially you've pointed it out so rightly, that swing traders and position traders, if you're new into the whole swing trading thing, then at times you may be caught up in maybe in some weird emotions, because at some point in time you're positive 300 pips, and then the next time you're looking at it, you're minus 50, and you're like, what happened? So
all right, so we just into more than half an hour speaking about how to protect yourself and consistent risk. I don't know whether Dennis is able to speak, whether you're able to join us, speaking about protecting profits, keeping a consistent risk in terms of the lot size which you're using, and also making sure you check out on the correlation of assets. I don't know whether we have another point on the next slides, Robert.
Actually,
okay, it's on our socials. So I don't know, Dennis, whether if you're able to get hold of this conversation, would work to hear your input on consistency in risk management and also correlation. But if you still have challenges on your connection, no worries. We can check out on the questions you have. Unfortunately, no question from my end. So we can call it a session, right, Robert?
Yes, we can.
All right. So on the socials, you can follow us on FXPesa.ke, Twitter,
LinkedIn, Instagram, and right here on YouTube. Follow us, get to share your feedback also. We love it when you share your feedback on what you think we should do better. make the recommendations, so that we are here to serve you. So that means we really value your feedback, so that we can make this program better for your advancement in this trading career.
That is awesome. And also I know you have social media. You're also in social media, Robert. Where can we follow you to get insights on the markets?
So Instagram, Mambogo Junior JNR. You can also find me on Facebook, Robert Matenge, Mambogo Junior JR. So there's a difference between the Instagram and Facebook. One is JNR and the other one is JR. So yeah.
All right. And I think when we have time, we will speak about the junior thing. It seems you have a story about it. And for me, you find me on Matthew MATHEW _Kabere KABERE. Right, we can speak more about these markets both on Twitter and Instagram. So up to that point, thank you so much, ladies and gentlemen, traders, for joining us in this session. We're really excited to be with you here, and see you on our next sessions. Thank you.
Thank you. Cheers. Have a good evening.
Bye.
Bye-bye.